The new financial year has ushered in several tax changes. Now, here are the most important 8 that can impact you and me. The first is the sweetened form of the new income tax regime, which is now the default tax regime for all taxpayers unless one explicitly opts for the old regime. The basic exemption limit in the new scheme has been hiked to 3 lakh rupees, and these are the slabs. We've got 5 slabs after the first exemption limit. The new regime also offers a tax rebate of 25,000 rupees under Section 87A on income just below 7 lakh rupees. This effectively means nil tax liability for those having taxable income up till this threshold. Rebate under the old regime will continue to be the same. That's 12,500 rupees, and that is only up to income levels of 5 lakhs. So that's an added sweetener in the new regime. This new regime also offers 50,000 rupees as standard deduction, which brings it at par with the old tax regime. So now if you're wondering which of these two is more tax friendly and which one should you opt for, here is a broad rule of thumb. If the total deductions that you enjoy and are using are more than 3,70,000, 3,75,000, then you may be better off in the old regime. Check out this quick example as a reference point. We've taken an income level of 15 lakhs. Both the regimes now have standard deduction, so the taxable income comes down to 14,50,000. In this example, we have assumed this individual is opting for deductions worth about 4 lakh rupees. That includes Section 80C deduction, Section 80D, which is your medical insurance, as well as Section 24, which is home loan interest. So all put together, we can see that the tax liability of this individual is actually lower under the old regime, 1,27,500, versus the new regime, where it's 1,40,000. Let's move on. The super rich have reason to cheer as the new regime offers lower peak surcharge rate of 25% versus the 37% peak rate under the old regime. This effectively lowers the tax liability for those earning 2 crore or more from nearly 43% to just about 39% right now. There is no reduction in surcharge rates under the old regime. That's all about personal income tax. Let's now talk about the biggest googly of Budget 2023, which actually came via the amendments to the finance bill. Now, from the 1st of April of this new financial year, any mutual fund that doesn't have at least 35% of its assets invested in domestic listed equity will be taxed at slab rates and not the 20% rate, along with the indexation benefit, which such funds enjoyed if the investor remained invested for 3 years. This move increases the tax incidence not just on debt mutual funds, but even funds which are investing in global equities or gold for that matter. Let's now quickly come to the third key tax change, insurance. The new fiscal takes away the tax efficiency of those high-value life insurance policies. Now, income from non-ULIP policies having an annual premium of rupees 5 lakhs or higher will be taxed at slab rates. However, payout upon death of the insured from such policies remains tax-free. Let's move to the fourth major tax change that pertains to market-linked debentures, or MLDs as they're called. The government has taken away the benefit of long-term capital gains tax regime that was applicable on MLDs till last year. Now, this year onwards, FY24 onwards, income from MLDs will be taxed as short-term capital gains. That basically means at your slab rates. Coming to the fifth key tax change. If you want to save tax on capital gains arising from the sale of a property or sale of any other long-term asset by reinvesting those gains in property, then the new fiscal year caps that tax relief at 10 crore rupees and no more. The sixth important change is higher tax on remittances. So this is under the LRS scheme, or the Liberalized Remittance Scheme, where barring remittances for education or medical treatment, the tax collected at source, or TCS, on all of the payouts has been hiked from 5% all the way up to 20%. Well, that's a lot of bad news, so let's bring you some good news towards the end as well. Senior citizens can now invest up to 30 lakh rupees in the Senior Citizen Savings Scheme, and that's a doubling of the earlier cap of 15 lakhs. The government has also made it easier to convert physical gold into e-gold and vice versa. Such conversions will not be treated as capital gains, and therefore they will not attract any capital gains tax. So there you have it, 8 key changes ushered in from the new fiscal year that can impact your life and mine.